Paul Christopher from Wells Fargo Investment Institute predicting at least one more hike with a recession on the horizon. And Wilmington Trust Investment Advisor CAO Tony Roth sees a soft landing in the cards, pulling back on his base case for a recession, but not moving back into risk just yet. Gentlemen, it's great to have you. Paul, let me begin with you and have you lay out the conditions by which we would get a hike yet again.
Yeah, we think you're going to see the Fed still have enough concern about inflation, maybe not at the headline level, but core is still very sticky. Food and fuel prices still rising, housing prices going up, rents again sticky. That's going to keep the Fed engaged. Any of these meetings is potentially live between now and the end of the year. So one more hike and then potentially into 2024. We think higher rates are going to be a problem.
Do you think that gets framed at Jackson Hole, or is it a function of many more data points coming in that run hot?
They've made it clear, the Fed has, that they're looking at the data on a month-by-month basis. We don't expect any real surprises from Jackson Hole, but we do expect a reminder that hey, look, the data aren't all benign, especially when you look at core inflation.
Tony, the Doves would counter with shelters coming online. It looks like used cars is not a head fake, given some of the alternative data that continues to come in, and there's deflation on that front. What do you think?
Well, we would agree with Paul that the Fed probably will hike in November, but we don't agree that they should hike. We believe that the Fed is going to be very, very careful to not put a stake in the heart of this inflation problem. But when you look at the data, you look at the CPI numbers that we had earlier this month, PCE coming out on August 31st, likely to follow that, what you see is a very strongly disinflationary economy. Notwithstanding the strength of the economy is disinflationary. The one area of the numbers that are holding up inflation at 0.2, in fact, is shelter, and shelter lags by around 14 months. So if you go back and you look at the Case-Shiller, what you see is that we should have around 6 months coming up of very weak disinflationary housing data that's going to push the month-over-month core numbers and super core numbers really quite low. And so I think that the Fed is going to stop after the next hike. And then when you look at the longer end of the yield curve, what we see is the downgrade, the situation with Japan, the refunding of the Treasury account, all in the short term, really pressuring yields. But when you go out a little further than that, it would appear to us that yields should be down maybe closer to 375 or so. And that makes bonds look pretty attractive when you consider where the yield could go coupled with the carry.
What does all that add up to for equities then, Tony?
Well, I think what it adds up to for equities is you have to be very careful and very selective. The leadership in the equity market really has been lost. Those big mega cap tech names are at very extended levels. When you look at multiples, excluding those top 7 or 8 securities, you're only around 14.5 or 15 forward-looking earnings over the next 4 quarters. And that means that if you're selective and you're looking at the value areas of the market and the quality areas of the market, such as consumer discretionary, diversified financials, travel, casual dining, all the service areas of the economy that have good quality names, there are some good buying opportunities there.